age-old debate of active versus passive management has kept many investors indecisive over the long term. But in uncertain markets like these, ETF-type trackers become the flavor of the year. The idea of an ETF-type product is to provide passive exposure to the respective benchmark at relatively low costs. Joining us from Cape Town to chat about Contego's ETF-type fund is the company CEO JC Louw. Now, JC, I hope you're not going to take offense at that, saying that it is an ETF type fund. Are you happy with that definition?
Yes, I am, Bronwyn. Actually, I'm going to sit here tonight as a fund manager picking stocks by day. I think if you're going to discuss the ETF, there's a big difference between, as you said, active versus passive. And yeah, it's not quite an ETF. It's a difference between the ETF and having a fund having a very close tracking error that looks a lot like the index. However, you can actually generate some alpha with good stock picking.
Contego means protection. Now, that is a big theme within your fund. So I'm just going to ask you to elaborate on why that is the underpin for you.
I think very topical at the market. Obviously, in the market at the moment, you've got a lot of risk in the market, yet the market's very cheap going forward. I think for the next 2-3 years or so, you want to be invested in equity. However, as short as 4 weeks away, you've got a Greek election. I think very shortly we'll go into a 2-week ban of no news. I think it's going to be the best time ever because the market sways on a minute-by-minute basis. So typical someone wanting access to the growth that equity can provide, we give you an equity fund that actually provides you downside protection should it happen. However, you can participate in the upside if there's any.
Well, that's what I was going to ask you. I'm hoping you're going to give us some upside as well, not just downside protection.
I think at the moment you've got, as I said, it's so much risk. If you take your equity basket and you add something like this protective basket around it, you just use SAFEX options. Options for the viewers out there, it's obviously the difference between a future and an option. Option gives you the profit should it happen, or you just pay away a premium. So it's quite a nice to have. It's almost like a hindsight tool. You would have wanted to do something, then you can actually do it. Otherwise, you just lose your premium.
So can you explain how you give us that alpha? You know, where you're different from someone who just takes an option and protects themselves?
Well, David, you could use your options for obviously 2 ways. Unit trust, typically not allowed to use derivatives. And the minute you use derivatives, I guess many viewers have actually got up to go fetch a cup of coffee. I want to invite you guys back. Derivatives can be used for good and for bad. In our instance, we actually employ derivatives to protect your cash against any downside. Now, an option, for example, a put, would make money if the market falls. So if you go and buy a put, you would make money on that asset should the market decline. And obviously, as I said, you would give away that premium. And an easy way to explain that is we all use medical aid on a monthly basis. And if you fortunately weren't ill or in a motor accident or any of some sort, you didn't utilize your medical aid, which means you didn't use your insurance. Now, the environment we've got at the moment, you've got a market going sideways, which means puts or derivatives in total is just not in favor. People are shying away because if you need to pay a premium and still make nothing in the market, you make nothing minus the premium. So people are not very fond of it, meaning you have to respond to the market and actually add something different to that in case the market recovers from you.
So how do you add that something different? And you didn't explain what basket you have. What basket do you actually buy, JC?
Well, Contego has been managing the same basket for many years, since 2004 odd. It's a top 20 style basket. It's very topical at the moment as well. Predominantly focused on the top 40. So you can venture outside the top 40 as well, as long as you pick funds that actually move like the market do. Now, a lot of people talk about a tracking error. The tracking error on this fund is less than 3.5%, which means we shouldn't get it wrong by more than 3.5% per annum, if it's a simple explanation. Now, if you've got a relative value biased, you basically go in and say, you're not looking specifically for a bank, you're looking for a better bank out of the 4 banks, for example, or the better gold company out of the 3 gold companies. So what you end up with is anything less than 20 shares, and you've managed to pick out the best one out of the lot. And once you start comparing the one against the other, it becomes a lot easier. And I almost want to tongue-in-cheek say, if you can just avoid the dogs, you don't have to pick the diamonds, you just need to avoid the losses, then you will make money.
Performance since 2004 inception, JC?
Pardon?
Your performance. Can you elaborate on your performance record since 2004?
Yeah, sure. This fund has been running, specifically our flagship fund, the Contego B5 Protected Equity. It was the first of its kind. We are known for being leaders in the protection market. The equity basket has performed about 2.1% per annum annualized alpha over the basket, over the top 40. So basically, if you look at it and you keep it simple, you really keep it simple without making it the complicated way. I mean, if you pick the better one, it works, and so far it has delivered about 2.1%. And that obviously, if you can utilize that alpha and maybe some of the dividend flows in the stocks, you can actually pay for your protection strategies, and it shouldn't impact your total returns that much.
JC, what are your dogs? What are the dogs that we should avoid in that basket or in your in the top 40?
Exactly. What do you leave out? We want to know what you leave out.
You know what, we just started the company. We started as predominantly private clients, and my first recommendation was to sell Richmond at that stage. And I had a couple of phone calls the next morning with a couple of disgruntled clients saying, how can you sell the company? Now, at the moment, without making a lot of people angry, I think what we've seen year to date, and it's just the shortest year to date, you've seen financials and industrial companies outperforming massively. I mean, you've got 10% in financials, you've got about 9% in industrials, yet you've got a decline of about 9% in your resource sector. So that trade, if you want to buy resources and sell some of your financial industrials, I'm actually quite favoring that. Obviously, you can't go full tilt or just bet the farm, but we are slowly but surely moving our resources weighting higher, heavier in the portfolio at the expense of some industrials. Financials we still think is quite sustainable for going forward, but some of the industrials are actually quite overpriced in our opinion.
Are you including platinums in that basket? Because we were just, before you came on, we were discussing the platinum market and how to avoid it. Where do you stand with your platinum shares?
It's a very difficult call. If you look at the union actions, if you look at the platinum price, it's not helping. If you see the world demand declining, if we happen to step into a deeper recession, which we currently, well, I firmly believe we've got a recession environment, even though the stats doesn't actually show it. So the demand is not quite there. I think the risks in the mining in South Africa is quite deep. It's still there. The costs are ever increasing. So it's not a favorable environment at the moment. Yet we are seeing a lot of voices sort of being uttered saying it could be a great buying opportunity. We have seen those shares are phenomenal performance shares once things recover. And if you're going to bet on the resources, my view would be to go for the diversified mining houses. If you look at Anglos, you look at Billiton, these guys are less than 10 PEs going forward, 1-2 years out. So you don't have to take a lot of risk. If you need to ask me one share, I'll probably just go Anglo-American, which is one of the biggest shares. And then once you see things turning, you see demand coming back, you see people stocking up again, vehicle sales recovering the way it is now, but just a little bit more momentum, I'll probably venture back into the platinum shares.